Bitcoin is exponential, the structural fact behind a decade of denial. Section 1. The law of the curve. Bitcoin is exponential. That's not a slogan, it's a structural fact. Every 4 years, the supply of new Bitcoin gets cut in half. The difficulty to mine it doubles, the energy cost compounds, and the awareness spreads geometrically. What starts as noise turns into a signal that eats the system that tried to ignore it. Mathematically, this is coded into its DNA. The halving schedule enforces digital scarcity with machine precision, from 50 Bitcoin per block in 2009 to 3.125 Bitcoin in 2024. The total supply asymptotically approaches 21 million coins, an economic boundary no central bank can cross. Meanwhile, the network's hash rate climbs exponentially, turning computation into collateral. Each new participant strengthens security. Each new node multiplies resilience. Psychologically, humans aren't wired for exponentials. We expect change to unfold linearly. One step, one outcome. But Bitcoin compounds quietly. Early believers are mocked, late adopters rationalize their hesitation, and by the time the mainstream gets it, the curve has already gone vertical. Exponential growth always feels invisible before it feels inevitable. Like a seed cracking underground, the moment of emergence looks sudden, but it was compounding all along. Section 2. Where we are. Cycle 4. The institutional era. It's 2025. Bitcoin is still early enough to be mocked, but late enough to be dangerous. The network has entered a self-reinforcing phase where adoption, security, and legitimacy feed one another. Every miner adds defense. Every holder adds credibility. Every skeptic becomes a future buyer at a higher price. We're in Cycle 4, defined by institutional and sovereign participation. Wall Street. The Securities and Exchange Commission's approval of spot Bitcoin exchange-traded funds in January 2024 brought BlackRock, Fidelity, and other asset giants directly into the arena. Authorized participants now include JP Morgan, Citi, Goldman Sachs, and UBS, the same banks that once dismissed Bitcoin as a toy. Sovereigns. Governments are now in the game. Bhutan's national investment arm mines and holds Bitcoin using hydropower. El Salvador mines Bitcoin with geothermal energy and keeps it on its national balance sheet. Ethiopia hosts industrial mining operations. Russia legalized large-scale mining through state-aligned infrastructure such as Bit River. State custody. Governments such as the United States hold over 325,000 Bitcoin from law enforcement seizures, effectively placing Bitcoin on national balance sheets. Germany and the United Kingdom have also held and liquidated seized Bitcoin. Collateralization. In 2025, JP Morgan, whose chief executive once called Bitcoin a fraud, moved to accept Bitcoin and Ether as collateral for institutional loans. The integration is undeniable. Bitcoin has crossed from speculative frontier to structural fixture. Section 3. The Skeptics. From Denial to Capitulation. Jamie Dimon, the reluctant convert. Few figures symbolize establishment finance like Jamie Dimon, the chief executive of JP Morgan Chase. He once called Bitcoin a fraud and threatened to fire traders who touched it. In 2025, his tone changed. He said, "I don't think you should smoke, but I defend your right to smoke. I defend your right to buy Bitcoin. Go at it." That statement came alongside JP Morgan's decision to let clients access Bitcoin trading, while the bank itself began accepting crypto collateral. He still complains that crypto enables money laundering and trafficking, but the facts betray the posture. His firm now profits from the very ecosystem he dismissed. Dimon has functionally capitulated, turning Bitcoin from pet rock to approved collateral. Warren Buffett, the final boss. If Dimon's conversion marked Wall Street's surrender, Warren Buffett remains the last fortress of disbelief. He once declared, "It's probably rat poison squared," and also said, "I wouldn't pay $25 for all the Bitcoin in the world. It doesn't do anything." Buffett's skepticism, rooted in 20th century value logic, now stands as a living fossil of pre-digital finance. When, or if he concedes, it will mark the closing of the skeptic era. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 4. The Halving Metronome. Bitcoin's Evolution in 5 Acts. Each Bitcoin cycle lasts about 4 years, punctuated by its programmed halving. Each era redefines who believes and why. Now imagine a table with 5 rows, each representing one halving cycle. Cycle 1 covers the years 2009 through 2012. It was the era of cypherpunks and outlaws. The narrative, digital rebellion, money outside the system. Cycle 2 covers 2013 through 2016. It was the age of speculators and retail adventurers. The Mt. Gox era, risk takers chasing volatility. Cycle 3 covers 2017 through 2020. It was the era of builders and decentralization architects. Ethereum, smart contracts, and stablecoins emerged. Blockchain beyond money. Cycle 4 covers 2021 through 2024 into 2025. The participants are institutions and nation-states. The narrative, from fringe to fiscal, Bitcoin integrates with the establishment. Cycle 5 is projected for 2025 through 2028 and beyond. The expected participants are central banks, energy producers, and machine-to-machine payment systems. The narrative, from asset to infrastructure, the base layer of the digital energy economy. Each halving compresses supply, magnifies scarcity, and expands the participant set, from cypherpunks to banks to nations. Section 5. What comes next? Cycle 5. From asset to infrastructure. If the last decade was about legitimacy, the next will be about integration. Cycle 5 could bring the following shifts. First, sovereign accumulation. States adding Bitcoin to reserves intentionally, not just through seizure. Second, energy symbiosis. Resource-rich nations using hydropower, geothermal, or flared convert surplus energy into digital gold. Third, financial replumbing. Bitcoin accepted as prime collateral, Bitcoin-backed bonds, or synthetic reserve assets. Fourth, machine-scale settlement. Lightning and sidechains enabling micropayments between artificial intelligence systems and connected devices. And finally, cultural inversion. The very skeptics who laughed at Bitcoin become case studies in exponential blindness. Section 6. The meta implication. Exponential systems don't ask for permission. They reward foresight and punish delay. By the time the average person understands what's happening, the compounding curve has already escaped comprehension. Opportunity shrinks as awareness grows. So when someone says it's too late, what they really mean is they don't understand how early exponential still feels right before it flips the world upside down. Section 7. Epilogue. The inevitable conversion. From cypherpunks to bankers, from the Silk Road to sovereign wealth funds, Bitcoin's path follows the same pattern. Disbelief, ridicule, engagement, absorption. Jamie Dimon already folded. Warren Buffett stands alone, the final boss of skepticism. But even the Oracle of Omaha can't argue with math. Because in the end, Bitcoin doesn't need belief. It just needs time. And time, in Bitcoin's world, halves every 4 years.